Today, we are diving headfirst into the world of accounting, demystifying one of the fundamental concepts, debit versus credit. Whether you are a newbie or just need a refresher, this video is your one-stop shop for mastering the accounting basics. So grab your calculators and let's get started. Alright, before we unravel the magic of debits and credits, let's set the stage. Imagine you are running a business or managing your personal finances, and you need to keep track of every financial transaction. Sounds overwhelming, right? Well, that's where our trusty accounting system comes into play. First things first, what the heck are debits and credits? Think of them as the yin-yang of accounting. Debits are like the left side of the scale, and credits are the right side. They are the two sides of every financial transaction. But here's the kicker, they don't mean bad or good. In accounting, debit and credit are fundamental terms used to record financial transactions and represent changes in account balances. They don't have the same meaning as in everyday language. Instead, they are used in a specific way to ensure that accounting entries are accurate and balanced. To visualize these, we use T accounts. Debit entries are made on the left side of an account in a ledger. Credit entries are made on the right side of an account in a ledger. It's like our financial playground. When you make a transaction, you add to one side and subtract from the other. It's all about balance. Debits and credits are like puzzle pieces, and each account is a different piece of the puzzle. We have got assets, liabilities, equity, income, and expenses. But how do we know which side to put them on? That's where things get real exciting. Here's a secret weapon, the golden rule. Assets and expenses increase with the debits, while liabilities, equity, and income increase with credits. Let me rephrase this because this is the takeaway from this lesson. Debit represents an increase in asset accounts and expense accounts. Credit represents an increase in liability accounts, equity accounts, and revenue accounts. Memorize this and you are halfway there. For asset accounts, for example, cash, equipment, a debit entry signifies an increase in the account balance when assets are received or expenses are incurred. For expense accounts, for example, rent expense, utilities expense, a debit entry records the cost or expense. For liability accounts, for example, accounts payable, loans payable, a credit entry records an increase in the account balance when debts are incurred or liabilities are increased. For equity accounts, for example, common stock, retained earnings, a credit entry represents an increase in equity due to investments by owners or profits earned. For revenue accounts, for example, sales revenue, service revenue, a credit entry records income earned from sales or services. Now let's bring this to life. Let's consider the following hypothetical transaction. On November 1, Rohan Ahmed deposited $25,000 in a bank account in the name of TQC Bangladesh in exchange for common stock. We can understand that this transaction increases an asset account called cash and increases a stockholder's equity or owner's equity account called common stock. When an asset goes up, we debit it, and when an equity goes up, we credit it. The journal entry for this transaction, therefore, will be as follows. The beauty of accounting is that it always balances. Every debit has a corresponding credit. It's like a financial puzzle, and when everything lines up, you know you have got your books in order. Like anything else, practice makes perfect. So get those calculators out, work through some exercises, and soon you will be an accounting ninja. It's important to note that every accounting transaction follows the double entry system, where each transaction involves at least one debit and one credit entry. This system ensures that the accounting equation assets equals to liabilities plus equity remains in balance. In other words, the total debits must equal the total credits for every transaction. Debits and credits are the building blocks of accounting, allowing businesses and organizations to accurately track their financial transactions and maintain their financial records. Remember, it's not about being left or right, it's about finding that perfect balance. Keep practicing, and you will be a financial whiz in no time.